Hello everyone, welcome to Akira's Academy of Accounting and Finance. I know you all have entered 11th standard and you are going through the books and you are seeing these terminologies and you're like, oh my god, whether I made the right decision or not. But don't worry, I'm here to make your accounting journey as smooth as possible. Okay, so I know you all of you wants to know what is this term? What is accounting? Why there is a need to do accounting, and if at all you have to do it, how to do this. Okay, so don't worry, I'll cover all these aspects in the easiest way possible. Before we start accounting, let me give you one example. Your parents, they are working, they are earning salary, that is their income. So this salary is their income, and they all want to know what all expenses they are incurring. Okay, so how they'll get to know? They need to identify those expenses. Like they are giving salaries to maid, they are buying vegetables, fruits, there's grocery, electricity bill, then fuel expenses. During weekends, you go for a movie or a dinner, so entertainment expenses. The weather is changing, so fall sick. Anybody can fall sick, so medical expenses. So in all, if they want to know where their income is going, they need to identify the expenses they are incurring. After identifying these expenses, they need to measure it. Okay, like if you are paying money for it, then only you will get to know like where their income is going. So they need to measure in terms of rupees, that is their measuring unit. Okay, then they need to record it if they want to know, okay, this is my income, these all are expenses, how much will be my savings, how much I am saving from my income. So they need to record this, and after all this they get to know what their savings, and then they were be able to make certain decisions like whether to go for holiday, where to invest the remaining amount, whether to buy something, a car or furniture, etc. So when they do all this, then they will get to know something. Okay, that is what is accounting. Accounting is being done each and every place. Now, we are studying here about the business organization. Business organization, numerous transactions are happening, and the businesses wants to know how to run their business, and to run their business they need to know what all expenses they are incurring, from where the income is coming, how much they'll be left with, and with that money whether they are incurring losses, okay, let's shut down, close the business, whether they are having more profitable business, let's continue with it. Okay, so the basic definition of accounting is, accounting can therefore be defined as the process. What is it? It is a process. It keeps on going of identifying, measuring, recording, and communicating. Identifying, we need to identify the transaction which are in monetary terms. Okay, so here you need to identify. Then measuring, whether it is measurable or not measurable. Like for example, there is an employee. Okay, that employee is very hardworking, but for some reason that employee has to leave the organization. That will affect the organization, but it is not measurable. We can't record it in the books. Okay, so whether the transaction is measurable, quantifiable, this is as good as quantification is can be done. Okay, if it can be done, then that transaction is considered. Then we need to record them. Record them in what? In a chronological order. We can say, oh, this transaction happened that day, then this transaction happened. We can't do like that. If a transaction has happened, we have to record it, and it has to be in a chronological order. Okay, and then it is communicated. Communicated to whom, I will tell you. So the transaction need to be identified, measured, recorded, and communicated. In our home example, we can't like whom to communicate. The your parents, those who are earning an income. Similarly, here the communication of information to be whom? To the owner of the business. And there are other people also. We will discuss about it. Communicating the required information relating to what? The economic events. Economic events, we can say the transactions that can be measured in monetary terms. Okay, transactions which can be measured in monetary terms, and events we can say they could be with anybody. There are two types, external and internal. Internal events means within the organization. Within the organization means the company paying the salary to the employees. That is within the organization. And external means outside. Outside to the to whom they are purchasing the goods. Okay, they are paying money to them. So the events which are happening within the organization or outside the organization, both relating to the economic events of an organization. Now, what is organization? Organization can be both. It can be for profit motive or non-profit motive. Okay, it covers all the organization. Accounting reports covers all the organization. Profit motive, there's a sole proprietorship, there is a partnership, there is a company, there is a body of individuals, association of person, all these things. Non-profitable organization like charitable institutions, all this is covered in an organization. So to whom, why they have to do it, why they need to communicate it, to whom? To the intended users. Okay, to the users of such information. Now who are the users? Now users are also defined in two categories, internal users and external users. Now see, internal users, okay, we get it, the owners. Who else? Who else are the internal users? Employees. Even employees wants to know how the organization is running, whether to continue with this organization or leave it as soon as possible before they kick it off from the organization. Okay. So owners, employees, they are workers, they are the internal users. And who are the external users? Government. They need tax. Okay. So they need to know how much the company is earning, how much the organization is earning, how much profit they are making. The bank and financial institutions. Now, if your parents, like how I said, they want to buy a car or they want to buy a new property, okay, they have so much of savings. Now, they want to buy something, they don't have so much of funds. So, what they will do, they will go to any banking institution. They'll ask for a loan. Now, before they give loan, the banks want to know how much your parents are earning the income, how much is their savings, whether they will be able to repay the loan amount. Similarly, and that amount is, I tell you, is very less. But here in the organization, it's a huge amount. So the banks and financial institution wants to check the accounting reports. They are the users, so they need such information. So accounting can be defined as the process of identifying, measuring, recording, and communicating. This is the most important thing. accountant must have the ability. It shows how much ability and proficiency the accountant is having, how he is communicating the accounting information, the required information relating to what the economic events of an organization to the intended users of such information. Okay, now you got to know what is accounting. Let's go to another aspect. Okay, so if you want to take a screenshot of this, you can take it. Okay, now when I say accounting, like what it becomes, we read the definition. So, what is accounting? The reports that we prepare, what is it? It is a source of information. It gives us information about the business. Okay, so we can say it as the language of business, how the business, what the business is communicating, how we will get to know from the accounting report. So it is the language. Accounting is the language of business. So when we say account, how, from where it begins with the identification of transaction. We identify the transaction, it starts with that. And where does this process end? With the preparation of financial statements. Financial statements are profit and loss accounts, balance sheet. I will explain all these things to you later, but these are the financial statements from which the uh, which will say about accounting. So it starts with identifying the transaction, it ends with the preparation of financial statement. And when we prepare the financial statement, what it will lead to? It will generate the information. It gives us the information of the business, and that information is not the end. Picture abhi baki hai mere dost. So it's not an end. What this information will do? It will disseminate the information, disseminate, spread the information. To whom it will spread? To the different users group. I told you there are internal users, there are external users. So to those different group of users, they will disseminate the information, and this dissemination of information will help when it's disseminated to the users. It will help them to take the appropriate decision. Okay, so this information will help them to take the decision. That's why we need to prepare it. So one thing is clear: what is accounting? You got to know why we have to do it. For this, we have to do accounting. And okay, now here, who will do all these things? The accountant, the one who prepare the reports, accounting reports, the financial statement is called accountant, and he has a major role to play. How he communicate is the crux. If he is not able to communicate, it can, the organization can dive into it. Okay, so the accountant, now we will discuss about the role of an accountant. What role does he? Okay, so now we are going to, I told you who has to do all this thing? The accountant. So what role does an accountant play? We are going to discuss about it. If you want to take a screenshot of this, you can take it. Okay, so what role does an accountant play? What he has to do? He has to recognize the events and transactions. Okay, events and transaction. He has to measure it, process it, and then he has to compile the reports. He has to make the reports of it, comprising of accounting information that are communicated to others. I told you, the users. And then what those users will do? They will interpret it, they will decode it, and then they will use that information. So when an accountant is preparing accounting report, he has a major role to play. And if he is not preparing it in a proper way, then it could affect the decision of the users. It could affect the decision of the users. So the accounting report, so it must be relevant, it must be adequate, and it must be reliable. It should be free from bias. He's not supposed to take anybody's opinions or interest. He has to prepare it in the most neutral way possible. Okay, it has to be free from biases. Okay, so the role of accountant is to prepare the accounting reports in such a way that it should represent the true and fair view. This is very important. It should be free from bias. That means it should represent true and fair view of the reports, okay, of the financial statements. So it must be relevant, adequate, and reliable. Okay. Now we will discuss the what qualitative characteristics of accounting information. What characteristic must accounting information hold? Okay. Okay, so now we are going to understand what qualitative characteristic the accounting information must hold. When somebody is looking into the books of accounts, when somebody is reading the accounting statements, looking at the financial statements, the reports, what quality it must possess. So the foremost quality it must have is it should be reliable, should be relevant, understandable, and comparable. Okay, so when I say reliability, how you can rely upon the accounting information when it is not being manipulated. Okay, when you have a trust on it. So it should not be based on somebody's interest, somebody should not do any sort of biasness with the accounting statements. So the first thing is it should be free from any kind of error and bias, no manipulation. When it is without any kind of manipulation, when it is free from bias, then and then only it will be credible, verifiable, neutral, and faithful. You can have a credit on it. It should be neutral. You can have faith on it, and it must be verifiable. Okay, so the second thing is relevance. Now when I say relevance, like you need to, it should be, the accounting information must be relevant. Like if I say, when you are going for an interview, right, and give your reports of first standard, second standard, are they even relevant at that point of time? Obviously not. Like you are going for an interview, what they want to see, how you have performed in your commerce subjects, how good are you in that. Okay, so relevance, it should be available in time, it should be related to that particular period of time, and it should be available at that point of time. Like if I need the financial statements, I want to go through the financial statements past year of say Hyundai, but financial statements of past year is not available, last year is not available, so how it could be relevant? So it should be available in time. When we have been provided the accounting information, we can predict about it. Okay, so it must help in prediction as well as feedback. We can the owners they can predict, okay, whatever investment they have made into a particular project, if that particular project is going good, how they will be able to know when they look to the reports. Okay, when they will see to it, and then only they can predict about it. Okay, we can go ahead with this particular project. So it must help in prediction and feedback, and it must influence the decision of users. Okay, it should influence the decision of users, the users who are using this accounting information, who are taking decision based on it. They can predict the outcomes. They can, when they shareholders are investing, when they look at the reports, and they can predict, okay, the company's reports are going good, I can invest in that. Okay, moreover, confirm or correct their past evaluation. They might have evaluated in past, the company, the organization might have evaluated in past how they have been performing, so they can confirm on it. Okay, our past evaluation, based on past evaluation, they took the present decision, and somehow they can take the decision for the future outcomes. Okay, so it must be relevant, that is, it must be available in time, it must help in prediction and feedback, and it must influence the decision of users, so that they can predict the outcomes or confirm or correct their past evaluation. The third thing is understandability. Now let's say, like, if I send a message to my father who is not an avid user of WhatsApp and everything, he don't know certain terminologies, and if I write like, if okay, if I send this message, like all of a sudden we are chatting, and if I send him, he will be like, what my daughter is saying, what is IYK? Okay, or the millennials, okay, and the Gen Z. Okay, now the Gen Z are using certain terms. I'm a millennial. I don't know what they are saying. When somebody says delulu, I don't know what is it. Say it in a proper way, right? Say delusion. So, like, these are certain terminologies which need to be clear, which need to be understandable when we are presenting the accounting reports, when we are giving the whatever the sender is trying to send, the receiver must understand it in the same way. He must uh, take it in the same way as it has been prepared and conveyed. So the decision maker must interpret accounting information in the same sense as it is prepared and conveyed to them. Okay, so how if it is understandable? Okay, and the last thing is it must be comparable. We are preparing accounting reports for what purpose? Okay, what is the use of preparing the financial statements? The first foremost is the between two periods, inter-period comparison, how I was doing in the past year, how I am doing in the present year. When I will prepare, then only I'll be able to understand, okay, whatever decision the entity has taken. So it must be inter-period comparison, as well as I just want to know how my competitors are doing, okay, or what strategies I need to follow. So it should be comparable over different time period as well as with other entities. Okay, so when we are preparing it, the reports must belong to the same accounting period. The natural calamities are happening, okay, so the natural calamities are affecting everybody in the same way. Okay, now when the reports are being belong to the same accounting period, the calamity happened in 2025. Okay, now if the reports are prepared in the same period 2025, it is affecting the organization in the same way. So it must belong to same accounting period. We will discuss about it, like there is a accounting period which starts from 1st April and ends on 31st March. The entities are supposed to prepare their accounting report in such a way. Moreover, it should use common unit of measurement and format of reporting. The unit of measurement, the rupees, it should be same for everybody, as well as the format, how they are presenting their financial statement, even that is specified. And if that isn't being done in the same way, it becomes easy for them to compare. Okay, so when we are talking the qualitative characteristic, the accounting information must be reliable, must be relevant, must be understandable, and must be comparable. Okay? Okay. So till now we discussed about accounting, what it is, and if we are preparing accounts, what qualitative characteristics and accounting information must hold. Okay, so initially when we started, I told you there are three questions which comes into your mind. First, what it is, why, and how. So what you know, what is accounting? Okay, it is a process of identifying, measuring, recording, and communicating the required information of economic events of an organization to its intended users. That is accounting. And these things, what characteristics it must hold, that also will we already discussed. Now, what is already discussed? Now you want to know why it is to be done, why there is a need for doing accounts, why we have to prepare the accounts. So the main objective of accounting are: first, the maintenance of records of business transactions. As we discussed, that we identify the transaction, we measure it, and we record it. Why there is a need to record it? So in a business transaction, in a business, numerous transactions are happening. The organization is selling goods, the organization is purchasing goods, and there is no only one seller or not only one buyer. Okay, They are buying from different people. They are selling to different people. And now to whom they are making cash purchases. They are doing credit purchases. They are selling the goods on cash. They are selling the goods on sales. To whom they are selling on cash, to whom they are selling on credit, how they will get to know? They need to record it. So the main objective is to record the business transaction so that it act as a proof, as an evidence. When we record it, okay, we get an evidence. Oh, we haven't something for us, like we can verify it. It can be verifiable if we record it. So it acts as an evidence for us when we record the business transactions. Okay. The second is calculation of profit and loss. Every business organization is running their business for some profit motive. So they also want to know how much profit they are earning and how much loss they are sustaining. This business is going smoothly. If we continue with this business, any changes are to be made. If there is a profit, okay, this business is going good. So we can make certain changes. But if at all there is a loss they are incurring, how to control it, how to curb those losses, what they need to take, what action they need to take. For that, they need to make their accounts. They need to prepare the reports, statement, financial statement, and from them they'll get to know whether they are earning profit or incurring losses and how to deal with it. Okay. The third is depiction of financial position. Financial position, when a company is preparing financial, organization is preparing financial statements, there are two statements. One is profit and loss account and second is balance sheet. Okay, what is balance sheet? Balance sheet shows the assets and liabilities. Now, what is assets? What is liability? An organization is running, and organizations need certain things to run an organization. They need an building, okay? They need furniture. They need machinery to run the business. So these are the assets. These are called the assets. How much they are owing the own. It's what is being owned by them and how much they are owing to somebody, how much they owe to somebody, how much they are liable to pay to somebody. As I said, like in the first example, take an example of your parents only earning an income. They want to buy something, they want to buy a new property, and that new property, they can't have that much money. So they go to the banks and ask for loan. So from there they get to know how much that is a liability for them, how much they are owing to pay to them. So that is considered as a liability. So when we prepare the financial statements, we get to know the financial position of the business. And the last one, as you all know, we have discussed, we prepare it for the users, providing accounting information to its users. Who are the users? As earlier I have also mentioned, there are internal users and there are external users. Internal users, the management, the one who is running the organization, they want to know how their organization is running so that they can plan about it, control certain things. Okay, if these expenses are going too much, if this is something they are not going good, so they can control it and they can make judgments, they can make budgets, they can take decisions based on it. So the management are called the internal users and there are external users. I'll discuss the list of external users. Okay, now when I say external users, who are external users? These are the external users, the investors and potential investors, those who are thinking of investing in the company, they are the investors. So the investors want to know how much is the risk and the return involved in their investment. Okay, okay, if this company is running in losses, they will not invest in it. They will try to take out their money from that company, that organization. So the investors, how they get to know how the company is running from their financial statement. When they provide the accounting information, from that only they will get to know how the company is running, whether it's earning profit or incurring losses. Second is unions and employee group. The unions, the trade unions, the employee group, those who are in the organization, they want to know how the company is, whether the company is stable, whether it's running, it's having profit. If it's having profit, how much they are going to give them as a bonus. So they also want to know how the company is going to distribute their wealth. Okay. The third is lenders and financial institutions. As I told you, there are banks who lend money to the organization to run their business. So if they are lending money, they want to know whether they will be, the company, the organization will be able to repay back their loan or not. So how they get to know? When they will ascertain how much they have, what's their financial position is, how much profit and loss they are incurring, from then they will get to know. The suppliers and the creditors. Who are the suppliers, creditors? The one who are selling goods on credit to the organization. So they won't sell it, like you need to have that creditability. Okay. If how to get to know about the creditability? From the accounting information. When they provide the accounting information, when they prepare the financial statement, then they will get to know, okay, we can give the goods on credit to this organization only if this organization has that much creditability that it will be able to repay back its money. Okay. The customers are buying goods. The customers wants to know, like, if, like, why we go for products which has a brand name, brand logo, because that has created such impact. Like, they will give you after sale services, they will provide you certain warranties, guarantees. Now, why they are doing it? Because they are having a good name. Okay. They are running in a smooth way. So from there, how they get to know it's running smoothly, everything is going good? From their books of accounts. Okay. From them only, the customers also wants to know whether this company is good. If it is good, okay, I can buy goods from this, and then that company will be able to give me after sale services. The government and other regulators. Government also wants to know whether it is as per the legal rules and regulations the organization is running or not. If they are incurring losses, if they are earning profit, how much tax they have to pay tax. There is a liability to pay tax, so whether they are paying their taxes properly, regularly or not. The social responsibility group. There are environmentalists who wants to know, they are running the businesses which is affecting the environment, so let's uh, stop them. So the social responsibility groups, how they get to know which business how much, and they have to keep certain amount uh, for the society, for the social environmental, for the environmental group. So they also want to know. And the competitors, they need to make their strategies. These all want to know how the company is running. The competitors want to know how to do the strategy. They need to get a strategic information from their accounting information. Okay. Okay. The next topic that we are going to discuss is the role of accounting. We have already discussed what is the role of an accountant. Okay, what role does he plays? But when we are preparing the financial statements, when we are doing accounting, what role does it play? Like, what accounting does? It collects the data, it prepares the reports and statements, and then it is being communicated to the users so that they can take decisions. Okay. So what accounting does, it tells something about what, about the business. So we can say it is a language of business, how the users are going to know what's going on in the business, how they will be able to know by looking at the accounting report. So it is considered as a language of business. Secondly, as a historical record, that all the transactions are being taken into account in a chronological order. All the records are being taken into account. So if I want to see what happened last month, what happened on that particular date, Okay, on that particular date, which transactions happen, everything is recorded because it is being recorded in a chronological order. Transaction happen, it is recorded in that particular day itself. So it is considered as a historical record. All the information is available. Secondly, as current economic reality, what is the reality of the business, how the business's wealth is changing over a period of time, what position the business hold, what is its current economic reality. As an information system, who is providing information? The accounting reports. With the help of the accountants are giving the information to whom? To the users, so that they can predict, they can evaluate, they can take the decisions. Okay, so it worked as a information system. And lastly, as a commodity, this is kind of a service that is being provided to the society. The society want this service, the people, they want this service, they want accounting reports. So it act as a commodity for whom? For the accountants who are willing to who are willing to provide these services. The only disadvantage this accounting hold is that it is completely quantitative in nature and financial in nature. It does not take into account the qualities and non-financial transactions that are happening in the organization, which actually matters a lot. So that is the thing. I can say it's a disadvantage, but the major role that is played is by accounting. It's considered as a language of business. It is a historical record. It shows the current economic reality. It gives the information, and it is act as a commodity. Okay. Okay. So instead of going the terminologies step by step, just want you to fix this image in your mind. And what is this? This is the financial statement that every entity has to prepare. Okay, so this is the end of the accounting. Like when we say the accounting process, when we start, it starts with identification of transaction. We record those transactions, and where does it end? In the preparation of financial statements, trading account, profit and loss account, and balance sheet. And whatever terminologies which I am going to teach you now is based on this financial statements. Okay, so let's start. Let's start the first terminology. The thing is, for whom we are preparing this financial statement? For an entity. Okay, now the entity could be a sole proprietor. Sole proprietor means single owner, the grocery shop owners or any small business firms. There's a partnership firm and companies, association of persons, body of individuals, non-profit organization. They are considered as an entity. And in this, entity is considered as a separate legal entity. The owner is different, the entity, the organization is different. So this financial statements is being prepared for the entity only. Okay, the owner is considered as a person to whom the entity is liable to pay whatever amount the owner has bring into this entity. Okay, so this financial statements relates to the entity. Now what it relates, what it carries, what we are doing here, we are recording the transaction. So second terminology is the transaction. Now which transactions? Transaction that can be measured in monetary terms, that's it. Other than monetary terms, those transactions are not recorded. I gave you an example earlier also, that there is a person who is very capable, who is very effective, who is very hardworking, efficient, and that is helping the entity in the best way possible. But somehow he has to leave the organization. Now it is going to affect the organization. It's not like that, but that will not be recorded. Okay, so only and only those transactions which are being dealt in monetary terms are recorded in the books of accounts. Okay, so transaction. Now which transactions are recorded? First and foremost, what does the owner bring? He brings certain amount. To run a business, we need certain amount, and that amount is being brought by the owner. What is it called? It is called capital. capital. It may be in cash, or it may be in any other form, like if he's bringing his motor vehicle or something, that is all considered as a capital. Okay, so that becomes something which the entity is supposed to pay off to the owner. It is a liability for the entity. So the capital is the amount invested by the owner in the organization. Okay, now when this entity is formed, we need certain things. We need a building. We need to develop the furniture. The grocery shop owner, he has to buy certain furniture to run his business. All these things are not related to the business that he is dealing with. Okay, he's not dealing with those business. He needs those things to run his business. Now what all these things are called? These things are called assets. Assets, it can be non-current assets, it can be current assets. Now non-current assets, that is considered as a, there are other forms like fixed assets like tangible assets, intangible assets, non-current investments. They all come under the non-current assets. Then you need a building, you need a land, there are certain machinery you need, there's something furniture you have to make, you want motor vehicles. Similarly, there are certain current assets. Current assets, like you need cash. Okay, these terms I will explain when we go through the other terminologies. So there are non-current assets, there is a current assets. Non-current assets which will be used over a period of time. But current assets will be utilized within 1 year. Okay. Similarly, there are liabilities like non-current liabilities. There are current liabilities. Now, non-current liabilities, if I want a building, now that building, for that I need a money. Okay. Now that building cost is 50 lakhs. Okay. Now I am not having 50 lakhs, but I need money for that. To whom I'll go? To the banks and financial institution. What they will provide me? They'll give me loan, and that loan will be a considerable period of time, exceeding 1 year, maybe for 10 years, 20 years, 50 years. So that becomes the long term loans. Okay, and that loan is supposed, the entity is supposed to pay to the banks and financial institutions. So any liability which exceeds a period of 1 year becomes a non-current liability, and current liability as same, which will be paid off within 1 year, becomes a current liability. Now to run the business, what we need? We need the items. Okay, the grocery shop owner need the grocery items to run his business. So what is it called in accountancy? It is called goods. Those things are called goods. Now that goods he will purchase, that is called purchases, and he will sell it, it is called sales. The goods that is being dealt in the business for a period, like in the business which is dealing with those goods, are called purchases. We purchase those goods and we sell those goods. Now for those purchases, the goods that we are purchasing, we are spending certain amount to bring those goods from the factory to the place where we are dealing with it. So we have to bring it from a truck or something. We have to pay the loading and unloading charges. So any expenses that we are incurring to bring the goods to the premises, they are considered as a direct expenses, and that direct expenses are being recorded here in the trading account. All the direct expenses related to the goods are being recorded in the trading account. But there are certain indirect expenses. There is a person whom you have hired to do all other things. You pay him salaries. There is an electricity bill that you are paying. You have a go down near to your premises, and that go down is rented. You are paying rent for that. There are certain stationery items you need to buy. So all these form indirect expenses. They are not directly related to the goods, but to run the business you are incurring certain expenses. So they are indirect expenses. Similarly, there is indirect income. You have certain area near to your shop, you are giving that area to somebody to run a small business. the pani puri owner, like he runs most of the places. So that vendor, you are giving that area to him, he is giving you rent. That is an indirect kind of an income. To sell certain thing of somebody, you are putting in your shop and you are charging commission for it. So these are the indirect income. Okay, so now you learn there are expenses, direct expenses and indirect expenses, and there is an income. Now uh, when uh, this is called expenses. But what we are buying, these things, building, land, plant and machinery or furniture, these are not considered as expenses. There is another terminology for it. It is called as expenditure. Expenditure relates to the, which does not relate to the goods that we are buying to run our business. But if we are buying any motor vehicle or if we are constructing the furniture inside the premises, that becomes my expenditure. Okay, now for that, like for building, okay, now the building is being used for around 10 years. That building has a term, like we are using it, that building, or we are using any motor vehicle for a period of 10 years, let's say. There's some amount is being uh, used for, like that asset is being used for a period of time. So that asset reduces its value, that the value of this asset get reduced. Now that value, like I have got a building for 50 lakh, but I have used that building, that building's value will depreciate. It will be, the value of that building will reduce, let's say by 5 lakh. So that 5 lakh is my expense, yearly expense, which will be recorded here. But not 50 lakh. 50 lakh is the expenditure which will be utilized over a period of time. So the value diminishes. 5 lakh, that's every year 5 lakh will be charged. That 5 lakh is the expense related to it, which will be charged in the profit and loss account. Now when let's say I have got a motor vehicle. Now that motor vehicle, I got it for 20 lakh. Now I don't need that vehicle. I am planning to sell it and buy something new. So I sold that vehicle for 20 lakh 50,000. Now I got this 50,000. What is this 50,000? This is the gain. This is called gain. Now why I am telling you gain? Because there is a term called profit and loss. This is not profit. What is a profit? Profit means your revenue is more as compared to their expenses. That the difference is called as a profit. You are running your business. In that business, you are, what is your major source of income? Is the sales and the indirect income. If this exceeds more than the losses, than the expenses, then we get a profit. I'll tell you the gross profit and net profit, but this is called as a profit. So profit is different, whereas the gain is different. Gain is on sale of a fixed assets, which is not used for the uh, daily buy and sell of the businesses. Okay, so the gain is different, profit is different. For loss, the same terminology used. For example, if I'm selling it for 19 lakh 50,000, then that 50,000 is my loss. It is considered as a loss only. And if the expense is more as compared to the revenue, as compared to the income, then that is also considered as loss. Now in that business, I am purchasing the goods. I'm purchasing the goods. Now the purchase is not always on cash. I'm not buying the things only on cash. There could be cash purchase and there could be credit purchase. When I am purchasing the goods on credit, I'm buying the goods on credit. Those, the from whom I am buying, he becomes my creditor. And similarly, sales. Now, even I am not also selling the goods on cash only. There is a cash sales and there is a credit sales. Now, when I'm selling the goods on credit, now the person to whom I'm selling becomes my debtor. Now, when I say these terms, debtors and creditors, they are my current assets and current liabilities whose liability will be paid off within 1 year. In the next financial year, this liability will be paid off. So that becomes my debtors to whom, to the person who is owing to me, and my creditors to whom I owe. Okay. So I think, yeah. Now there is a term called stock. Stock means what? I have purchased 10 units of something. I have sold 8 units already. Remaining is 2 units. That 2 units becomes my stock. That is called the closing stock, as well as it is also called inventories. The stock that is remaining after selling the goods in the financial year. Okay, in that financial year, whatever is remaining, that is my stock, and that closing stock becomes the opening stock of the next year. So thus, that is stock. I think I have covered all the terminologies, and we will go through certain other terminologies as and when we go through the next chapter. There are other terminologies: bills receivables, bills payables, deferred revenue expenditure. Like I said, there are fixed assets, there are tangible assets, there are intangible assets. What is tangible? Tangible, which we can see, which we can touch. Intangible, which we cannot see, which we cannot touch, but still they are considered as an asset, like the goodwill, patent, copyright, trademark. They are also considered as asset. We will go through those terminologies as and when we will go through the next chapter. Okay, so let's see you in the next chapter. The next chapter is a theory base of accounting, wherein I will tell you what things we have to keep in mind while preparing the financial statements. See you in the next chapter. Bye bye.